Let's go ahead and go through the solution to question 4 from the Module 2 homework. This is a very short and straightforward, about to say short and sweet, but it's not short and straightforward, consolidation at date of acquisition of a wholly owned subsidiary acquired at book value. So here we have the information. On January 1st, 18, Big Company acquired 100% of the voting stock of Little Company for $300,000. On that date, Big and Little had trial balances as indicated below. Prepare the appropriate elimination entry and complete the consolidation at date of acquisition worksheet. The book value of Little is $300,000. That means that Big paid exactly book value. Now, to determine the book value, we can do one of two things. We could do net assets. Total assets $450,000 minus liabilities of $150,000 leaves us with a book value of $300,000. Or, since there are no temporary accounts open, that is revenues, expenses, or dividends, it's simply the sum of the equity accounts. If there were open revenue, expense, or dividend accounts, then the book value would be the net assets, assets minus liabilities. You could not simply add up the total equity accounts without going through a closing process first, of closing revenues, expenses, and dividends to retained earnings. In any event, our elimination entry, S, for start, we're going to go ahead and eliminate these subsidiaries beginning of year owner's equity accounts, common stock, paid-in capital in excess of par, and retained earnings. Those are all equity accounts with credit balances, so to eliminate them we will debit those accounts. And we credit the investment in Little for that $300,000. Debits equals credits, obviously. Once we do this, then the remainder of the process is simply mechanical. We take the debits and post them to the debit column, the credits and post them to the credit column. So debiting common stock, debiting paid-in capital in excess of par, debiting retained earnings, and crediting the investment in Little. Once we do this, we simply add across each row, keeping in mind our debit and credit rules. So first, cash, receivables, and inventory, we simply add straight across. For the investment in Little, we have a $300,000 debit balance under the big column for investment in Little. That's being offset or canceled out or negated by a $300,000 credit, leaving us with a net balance of 0. And the remainder of the assets we simply add straight across. Similarly for the liabilities, there's nothing in the adjusting column for the liabilities, so we simply add straight across. And then for our three equity accounts, again, what we're essentially doing is eliminating Little's equity accounts. So we're left with Big's common stock of $50,000, Big's paid-in capital in excess of par of $100,000, and Big's retained earnings of $400,000.